It was a Tuesday in late March, and the man sitting across from me in my office had a manila folder in his lap that he would not put down. His name was Walter. He was 74 years old, a retired high school shop teacher from Ohio, and he had built his whole life around being careful. He kept every receipt. He balanced his checkbook by hand. And he had just received a letter from the Internal Revenue Service telling him he owed a penalty of nearly $4,000. Not because he had cheated anyone, not because he had hidden a dime. He owed that penalty because of a single deadline he did not know existed. He kept turning that folder over in his hands, and he asked me the question I have heard more times than I can count. He said, "Emma, how was I supposed to know?" And the honest, painful answer was that nobody told him. Walter had turned 73 the year before. He had a traditional retirement account he had faithfully paid into for decades, and the moment he crossed that age, a clock started ticking that he never heard start. The government expected him to pull a specific amount of money out of that account and pay tax on it, and because he did not, the penalty landed. He had done everything right his whole life and got punished for the one thing no one had ever explained to him. I remember he took his glasses off and pressed the heels of his hands into his eyes, and he said the money was not even the worst part. The worst part was feeling like the system had set a trap and waited for him to walk into it. I have never forgotten the look on his face. And here is what nobody told Walter, and what almost nobody is telling you either. The tax rules that govern your retirement are not built around a single April deadline that you already know about. They are built around a whole calendar of quiet deadlines scattered across the year, and each one carries its own penalty for missing it. The system does not send you a reminder. It does not call. It simply waits, and then it bills you. Over 15 years of doing this work, I have come to believe that the single most expensive thing a retiree can be is unaware, because in retirement, the mistakes are no longer about how much you earn. They are about what you fail to claim, what you fail to withdraw, and what you fail to file before a date you never saw on any calendar. Today, I want to walk you through those dates the way I wish I could have walked Walter through them before that letter ever arrived. Let me introduce myself properly, in case this is the first time you and I are sitting down together. My name is Emma Smith, and I am a state bar licensed estate attorney with more than 15 years spent representing families, retirees, and homeowners exactly like you. I have sat in the room for the good days and the terrible ones. I have read the letters from the IRS out loud to people whose hands were shaking. And I have learned that most of the pain I see is not caused by bad decisions. It is caused by missed dates and unclaimed benefits that no one ever explained. Before I go any further, I want to be completely honest with you about one thing. I do not make a single dime from anything I am about to tell you today. I am not selling you a product. I am not signing you up for anything. There is no service waiting at the end of this video with its handout. This is simply the information I wish every client had walked in already knowing. Here is the pattern I have watched play out for 15 years. And once you see it, you cannot unsee it. Every one of these retirement tax rules works on the same silent principle. The benefit or the obligation exists. It is written into the law. The money is either owed by you or owed to you, and then the government simply waits to see whether you act in time. It does not chase you to give you a break. It only chases you to collect a penalty. I want to say something to you that I say to every client, and I want you to really hear it. Eligibility is not the same thing as receiving, and awareness is not the same thing as acting. You can be fully entitled to a tax break and still lose it. And you can fully owe a small obligation and turn it into a large penalty, purely by letting a date pass.
You might wonder why nobody makes this simple. Why the IRS does not just send a friendly note each year listing your personal deadlines. The answer is not a grand conspiracy. It is something quieter and, in a way, sadder. These agencies are built to process, not to advise. They will happily take your correct filing, and they will happily assess your penalty. But nowhere in their job description is it written that they must teach you the rules before enforcing them. That gap, between what you are expected to know and what anyone ever tells you, is exactly where families like Walter's lose money. So I am going to spend the rest of our time together closing that gap. I am going to walk you through the deadlines I most often wish I could have warned a family about before it was too late. And I want you to keep a pen nearby, because some of these you will want to write down. Let me start with the exact deadline that caught Walter, because it is the one I lose the most sleep over. If you have a traditional retirement account, a traditional IRA, or a 401k from an old employer, the law requires you to begin taking money out of it once you reach a certain age. That is called a required minimum distribution, and as of the current rules, the age it begins is 73. Here is the part that trips everyone up, and it is exactly what caught Walter. For your very first required distribution only, you are given a small grace period. You do not have to take it by December 31st of the year you turn 73. You are allowed to wait until April 1st of the following year. It sounds generous. It is actually a trap, and let me tell you why. Because if you use that grace period and wait until April 1st to take your first distribution, you still have to take your second one by December 31st of that very same year. That means 2 full taxable withdrawals land in a single tax year, which can push you into a higher bracket and quietly raise the tax you pay on your Social Security and your Medicare premiums all at once. Walter did the opposite mistake. He heard April 1st, assumed he had plenty of time, and then simply forgot the date entirely. And here is what the missed distribution costs. Historically, the penalty for a missed required distribution was a brutal 50% of the amount you should have taken. Under the current rules, it has been reduced to 25%, and it drops to just 10% if you catch the error and correct it within 2 years. That reduction is a lifeline most people never learn exists.
And there is a second thing I saw in Walter's same case that mattered even more, and I will get to it in a moment. Here is what I told Walter to do, and what I would tell you if you are in the same spot. If you have missed a required distribution, you take the missed amount out immediately, and then you file IRS Form 5329 to report it, and you can attach a letter requesting a waiver of the penalty for reasonable cause. The IRS grants those waivers far more often than people expect, especially for a first honest mistake. In Walter's case, we withdrew the money, filed the form, wrote the letter, and a good chunk of that $4,000 penalty was ultimately forgiven. But I want to be clear with you, because this is your money and your risk. The exact amount you must withdraw depends on your account balance and your age, and the rules have layers I cannot fully cover here. So before you act, confirm your specific number with your account custodian or a licensed tax professional. Use what I am telling you as the warning. Let a professional confirm the arithmetic. There is a second thing I saw in Walter's same case, and it is one that catches millions of retirees who never once worried about it during their working years. When you had a job, your employer withheld taxes from every paycheck automatically. You never had to think about it. But in retirement, a great deal of your income arrives with no withholding at all. Distributions from certain accounts, rental income, interest, dividends, even a portion of your Social Security can all arrive without a penny of tax taken out. And the IRS does not simply wait until April to collect. It expects you to pay your taxes as you go in 4 installments across the year through what are called estimated quarterly payments. Miss those, and you owe an underpayment penalty even if you pay every dollar by the following spring. Let me give you the 4 dates, because these are the ones I want on your refrigerator. For the 2026 tax year, your estimated payments are generally due on April 15th, June 15th, September 15th, and then the following January 15th of 2027. Notice how uneven those windows are. The first covers 3 months, the second only 2, and yet people assume they are evenly spaced and get caught. The form you use is IRS Form 1040-ES, and it walks you through estimating what you owe. Walter had never made an estimated payment in his life because for 50 years, someone else had handled it for him. The transition into retirement is exactly when this obligation quietly switches onto your shoulders, and nobody hands you a memo the day it happens. And there is a second thing hidden inside this same problem that I want you to hear, because it is the part that actually saves people money. Here's the move I taught Walter that changed everything for him. You do not actually have to juggle 4 separate quarterly payments if you do not want to. There is a quieter option that most retirees are never told about. You can ask the payer of your retirement account distribution or the Social Security Administration to withhold taxes directly from your payments, just like an employer used to. Money withheld this way is treated by the IRS as if it were paid evenly across the entire year, even if it all comes out in December. That single feature can rescue someone who realizes late in the year that they have underpaid. For Social Security, you file a Form W-4V to set up voluntary withholding. For an account distribution, you ask your custodian. It is one of the simplest, most powerful tools I know, and almost nobody uses it because almost nobody knows it is there. Now I want to tell you about a deadline that works in the opposite direction, one that gives you money rather than taking it, and yet gets wasted just as often. Many people assume that once they retire, they can no longer contribute to a retirement account. That is not true if you or your spouse still have any earned income at all, even part-time work. And the deadline to make a contribution for a given tax year is not December 31st the way most people assume. You actually have until the tax filing deadline of the following April. So a contribution counted toward your 2025 taxes could be made all the way up to April of 2026. That extra window is a gift, and it slips past people every single year because they assume the year-end is the wall. Let me give you the current numbers so you know exactly what is on the table. For 2026, the total you can contribute to your IRAs is $7,500 if you are under 50, and $8,600 if you are 50 or older, because of what is called the catch-up contribution. That catch-up is specifically designed for people in your stage of life, and it exists precisely so that older savers can put away more. I had a client, a widow named Diane from Arizona, who was working 2 mornings a week at a local library mostly for the company, and she had no idea that small paycheck made her eligible to keep funding a Roth account. We set it up, and she funded it right up to the April deadline for the prior year. She was genuinely stunned that a rule had been working in her favor the whole time, and no one had ever mentioned it. There is a second thing about Diane's situation that I will come back to, because it connects to the deadline that saves the most tax of all. Let me tell you about the single most elegant tax move I know for a retiree who gives to charity, because it ties directly back to that required distribution we started with. Remember Walter and his required withdrawal that pushed up his taxable income? There is a way to satisfy that required distribution and pay zero tax on it, and it is called a qualified charitable distribution. Here is how it works. If you are 70 and a half or older, you can direct money straight from your traditional IRA to a qualified charity, and that amount counts toward your required distribution for the year, but it never shows up as taxable income to you. It bypasses your tax return entirely. For someone who gives to their church, their food bank, their alma mater, this is transformational, because the ordinary way of giving often provides no tax benefit at all anymore. And the numbers here are not small. For 2026, you can direct up to $111,000 per person through a qualified charitable distribution. And for a married couple where both spouses have their own IRAs, that is $111,000 each. There is even a special one-time provision that lets you use a portion of it, up to around $55,000, to fund certain charitable gift arrangements. But here is the deadline that matters, and it is unforgiving. The distribution has to actually leave your account and reach the charity by December 31st of the tax year. Unlike a contribution, there is no April grace period for this one. If it does not clear by year-end, it does not count for that year. I have watched people mail a check on December 29th and have it fail to clear in time, losing the benefit entirely. So if this move is for you, you started in November, never the last week of December. There is a fifth deadline that I rarely see anyone circle on a calendar, and it is one of the most powerful planning tools available to a retiree in a lower income year. It is the deadline to complete a Roth conversion. A Roth conversion is when you move money from a traditional account, where withdrawals are taxed, into a Roth account, where qualified withdrawals come out completely tax-free for the rest of your life and for your heirs. You pay tax on the amount you convert in the year you do it, which is why timing is everything. The strategy is to do conversions in the years when your income happens to be lower, often those early retirement years after you stop working, but before your required distributions and full Social Security kick in. And here is the deadline that people get wrong constantly. A Roth conversion must be completed by December 31st of the year you want it to count for. There is no do-over in April. Unlike a contribution, you cannot look back after the year ends and decide to convert for the prior year. Once the calendar flips, that lower income year is gone forever. I once worked with a couple, Harold and Ruth from Wisconsin, who had one unusually low income year right after Harold retired, and we used it to convert a meaningful chunk of their traditional account to a Roth at a very low tax cost. The savings will follow their family for decades. But I have to be honest with you, because this is genuinely complex. A conversion done carelessly can spike your Medicare premiums 2 years later and can affect the taxation of your Social Security. This is precisely the kind of move where you sit down with a licensed tax professional before you pull the trigger. The deadline is firm, but so is the need for advice. The 6th deadline I want to give you has nothing to do with the IRS at all, and it is the one that most directly touches you as a homeowner. Almost every state offers some form of senior property tax exemption or relief for homeowners 65 and older. And just like everything else we have discussed, it does not apply itself. You have to file for it, and there is a deadline. And if you miss the deadline, you generally lose that entire year of savings. The dates vary widely by state and even by county, which is exactly why so many people miss them. In Florida, for example, the homestead and senior exemption application deadline generally falls on March 1st. In Texas, seniors 65 and up qualify for an additional homestead exemption and a school tax ceiling that freezes part of their bill. But the local appraisal district still expects an application. I want to fold in a warning here that applies to this deadline more than any other, because it is where I see good, proud people talk themselves out of money they are owed. Do not disqualify yourself from your armchair. I have had clients assume their home was worth too much, or their income was slightly too high, or that the exemption was only for people truly struggling, and in case after case, they were simply wrong. Many of these senior exemptions have income limits well above what people assume, and some have no income limit at all. There was a retired nurse named Sylvia in Georgia who was certain she earned too much to qualify, sat on it for 3 years, and when she finally applied, she not only qualified, but in her county, the senior school tax exemption erased a large portion of her bill entirely. 3 years of relief she could have had, gone, purely because she assumed the answer was no and never asked the question. So here is exactly what to do, and it takes one phone call. You call your county tax assessor or property appraiser office, and you ask 2 specific questions. First, what senior or homestead exemptions am I eligible for? Second, what is the filing deadline and what documents do you need from me? Write the deadline down the moment they say it, and treat it like a medical appointment you cannot reschedule. Most of these applications only need to be filed once, and then the exemption renews automatically for as long as you own and live in the home. 1 phone call, 1 form, and then years of lower bills. Sylvia's mistake was not that she was ineligible. Her mistake was silence. And that brings me to a second story I promised I would tell you, because it shows how all of these deadlines can collide in a single family at once. A few years into my practice, a woman named Carol came to see me after her father passed away. Her father, a gentle retired machinist named Frank, had lived alone in the house he raised his kids in, and Carol was handling his affairs. And as she went through his papers, she found something that broke her heart a little. She found an unopened envelope from the IRS, and inside it was a notice about a missed required distribution, with a penalty attached. And then his daughter found the letter. Let me tell you what that letter set in motion, because it is a lesson I carry with me. Frank had done nothing wrong in his heart. He had simply gotten older, the mail had piled up, and the deadlines that used to feel manageable had quietly gotten away from him. The missed distribution was one thing, but as we untangled his affairs, we found he had also never filed for the senior property tax exemption he had qualified for since the day he turned 65, and he had been overpaying his estimated taxes for years because no one ever helped him right-size the payments. Every single deadline we have talked about today showed up in Frank's file at once. Carol sat in my office and said something I will never forget. She said, "If only someone had sat him down and explained all this while he could still act on it." That sentence is the reason I make these videos. That is the conversation I am trying to have with you right now, while you can still act.
What I learned from Frank, and from Carol going through his papers with tears in her eyes, is that these deadlines are not really about taxes. They are about dignity. They are about a person being able to keep what they earned and pass on what they built, without a preventable penalty eating into a lifetime of careful work. The tragedy of Frank's file was not that the money was enormous. It was that all of it was preventable. Every dollar, with nothing more than awareness and a calendar. Carol ended up recovering a good portion of what her father had lost, because many of these penalties can be appealed, and many of these exemptions can be applied for retroactively in some states. But the peace of mind that Frank himself never got to feel, that was gone. So if you take nothing else from our time together today, let it be the next thing I am about to say. If you take one single thing from this entire conversation, let it be this. In retirement, the calendar is your quietest and most expensive risk. And the good news buried inside that is that a calendar is something you can actually control. You cannot control the tax code. You cannot control what the IRS chooses to explain and what it leaves silent. But you can absolutely control whether the important dates are written down somewhere you will see them. The single most protective thing you can do this week is sit down for 20 minutes and build yourself one simple sheet with your own personal deadlines on it. Your required distribution deadline, your 4 estimated payment dates, your year-end conversion and charitable cutoffs, your property tax filing deadline. Every family I have watched avoid Walter's and Frank's fate did the same unglamorous thing. They wrote the dates down and they looked at the sheet. And I want to gently push back on a thought you might be having right now, which is that this is all too complicated to keep straight. I understand why it feels that way, because the system is genuinely designed in a fragmented way, with different agencies and different dates, and no one in charge of showing you the whole picture. But complexity is not the same as impossibility. You do not have to become a tax expert. You only have to become the person who knows which dates matter and who to call about each one. That is a far smaller job than it sounds, and it is entirely within your reach. Walter learned it in one afternoon in my office. Diane learned it in a single phone call. You can learn it from this video and one quiet evening with a calendar. To make that evening easier, I put something together for you.
Because I never want anyone to leave one of these conversations with good intentions and no tool to act on them. I created a free one-page retirement tax deadline calendar that lays out every date we discussed today in plain language. It lists the required distribution deadline and the first-year April trap, all 4 estimated payment dates for the year, the contribution and conversion cutoffs, the charitable distribution year-end deadline, and a blank space for you to write in your own state's property tax filing date once you make that one phone call. It also notes which form goes with each deadline, so you are never left wondering what to actually file. It is completely free. I am not collecting anything from you beyond pointing you to it, and there is nothing waiting behind it to sell you. You will find the link in the description below this video, and I have also pinned it to the top of the comments so it is easy to find. Here is my one request about how you use it. Do not just download it and let it sit in a folder on your computer, because a calendar you never open protects no one. Print it. Put it somewhere you physically pass every day, on the refrigerator, on the corkboard by the phone, inside the cover of the checkbook. You still balance by hand. And then, this week, pick the single deadline that is closest on the calendar and take the first step toward it. If your required distribution deadline is looming, call your account custodian tomorrow. If property tax season is near in your state, call the assessor's office. The sheet is only worth something the moment it turns into one phone call. Frank's file taught me that the gap between knowing and doing is where all the damage happens, and closing that gap is entirely in your hands. Now I want to ask something of you, and I want to ask it gently, the way I would if we were sitting together after everything I have just told you. Think for a moment about the person in your life who reminds you a little of Walter, or a little of Frank. The parent living alone whose mail is piling up. The older sibling who is too proud to ask for help with paperwork. The neighbor who mentions, a little too quietly, that a letter came from the IRS and they are not sure what to do about it. That person almost certainly does not know these deadlines exist, and they are the least likely of anyone to go looking. Would you send them this video? Not because I need the view, but because a single missed date can cost someone you love thousands of dollars and a great deal of dignity, and you might be the only person positioned to catch it in time. I have seen too many Carols sitting in my office, going through a parent's papers after the fact, whispering if only someone had told him. You have the chance to be the someone who tells them while it still matters. Forward this to one person in your family, or sit down beside them and watch it together, and then help them make that one phone call. In 15 years, I have learned that these deadlines are rarely missed out of carelessness. They are missed out of isolation, because no one was there to say, hey, let me help you get this handled. You can be that person for someone. That single act of looking out for another person is worth more than any form I could ever hand you, and it is the whole reason this channel exists. If this conversation gave you even one date you did not have before, then I would be grateful if you would subscribe and turn on the notification bell before you go. Every week, I sit down and walk through another one of these quiet corners of retirement that no one explains until it is too late, and the bell is the only reliable way you will know when the next one is ready for you. There is no algorithm looking out for your family's money, but I promise you that I am. One deadline and one story at a time. I am Emma Smith, and it has been my genuine privilege to spend this time with you. Go pick your closest deadline, make that one phone call, and do not let the calendar catch you the way it caught Walter. I will be right here waiting when you are ready for the next one. Take care of yourself and take care of the people you love.